Hey, everybody, welcome to Coffee for Closers. Alex Wellings here. I'm joined by Tim and Joe from postalbluebook.com and Gateway Insurance. They'll be talking a little bit with us about their life insurance strategies when talking with federal employees and some other stuff. We hope you enjoy the show. All right, everybody, welcome to Coffee for Closers. Alex Wellings here. I'm joined in studio with, I'm going to get this right the first time now, all right? Mr. Tim Nolan and Mr. Joe Cuny. We'll be talking all about life insurance here, and I was excited to bring you guys in. I'm glad you guys were in the office. We did some game planning today, but of course, wanted to pick you guys' brain a little bit about the life insurance approach you guys are using in the Fed space.
Yep.
Particularly your proclivity for whole life, which is an interesting concept in a world where everybody's getting preached by David McKnight to talk about IUL strategies. But, you know, I think maybe Dave, I don't know if he's more an advocate for IUL or really just tax-free retirement planning utilizing life insurance and maybe less inclined to throw whole life away with that. But you guys have really leaned into the whole life conversation. It's interesting to me because there's so many folks that watch this show that are in our programs that don't capitalize enough on life insurance, getting frustrated with the life insurance sale. If they are doing life insurance, are primarily just focused on going after the like a simplified issue product,
sure,
right? A workplace product.
Yep.
And so I'm interested to unpack that with you guys today. So thanks for both of you guys for being here with us.
Absolutely.
Sure. And so maybe guys talk a little bit about your experience. I know, Tim, we've gotten your experience before.
Sure.
But just remind everybody where you guys came from. I know you've been with us for a year or so, but you're relatively new to the Fed space, but having a wild amount of success.
We are.
And a lot of it, and I keep saying, is like, oh, there's ways to filter out some of the life guys potentially, or this is what you can do with those folks. And you guys are more inclined than anybody I've talked to want to embrace those folks and talk to them about the life conversation. So maybe just talk to us about your experience, and then we'll jump into maybe some of your product placement.
Yeah. So, when we're talking to the federal employees, obviously we're looking at the higher opportunities, right?
Yeah.
We're looking in the annuity space. We're looking at helping them with TSP.
Yep.
But if there's not that opportunity, maybe it's somebody that is 59 and a half, but they didn't do a good job saving. Right. Let's look for the different opportunity.
Yeah.
And so we feel that everybody has a life insurance need.
Yeah.
Everybody that we
particularly those that didn't save well.
Absolutely.
Right.
They didn't save well. So let's try to uncover a life insurance need. And so that's the path we go down. We don't just say, oh, you don't have any assets for us to roll over or anything. Thanks for coming. We'll check in with you later.
See you later.
Yeah. So we look down that life insurance path, and it's really helped grow the business because we're able to help a lot of people.
And before you were in the federal space, you guys were selling a lot of life insurance, right?
Yeah, we were selling a lot of life insurance, both fully underwritten and simplified issue, term and permanent. And then obviously, I think from one of our other episodes that we've recorded, we talked about the different types of permanent.
Right.
And, right now, especially dealing with federal employees, they're looking for guarantees.
Yep.
And so we promote the whole life. It's not that we won't talk about IULs or ULs, but for the reasons why we pitch it is the reason we start going towards the whole life.
So let's remind everybody about that conversation then. So you went into whole life and explain, maybe for those that don't know enough about whole life, to have any idea what it does. Yep. Or what the benefits of a whole life policy is over an IUL or a UL. Talk to them a little bit about why you've chosen whole life and what the conversation maybe looks like.
Yeah. So, when we're talking to federal employees and we're talking about FEGLI and the increasing in price every 5 years, and that it's basically a glorified group term policy and there's no cash value, we start focusing on what we call the 3 Gs.
Okay.
Guaranteed premium, guaranteed death benefit, and guaranteed cash value. And when you're dealing with a more conservative, risk-averse market, you want to try to get them involved and get them interested in something that's going to benefit them no matter what, whether that's using the cash value for retirement planning later,
right?
Whether it's making sure that when they do retire, this policy is going to stay in force and the premium's not going to go up because we know they're going to be on a fixed income, right?
Yep.
So they don't want to, start funding a UL and then it come up to lapse because they're not funding it properly.
Right.
And so that's why we've gone towards doing whole life. And again, it's not that we won't pitch IUL if somebody that's not so risk averse,
Mm-hmm.
but we lead with permanent whole life coverage. And I think in the marketplace and from an advisor standpoint, a lot of advisors have shied away from it because whole life has a aura that they're too expensive.
Yeah.
You know,
I mean,
that's why people don't
think about it. I think it's more expensive. Like, it's going to be a harder sell. You know, potentially the only benefit is if they really get in young. You know, that's really what I'm going to get them. I think folks agree that it is the better choice for a lot of folks.
Sure,
but because of the expensive costs in it, I got to get them in their 30s.
Well, and that's exactly why brokers look at the IULs.
Right, I'm going to play some catch up with some risk.
Right,
you know.
I can sell a lower premium amount, and this is going to be an easier sale rather than doing everything they really should be doing and taking the steps to making sure you're putting them in the right product.
It's interesting because, you know, as we're talking about that, I'm really just thinking is like how contrary it is, the IUL sale, to the guy in the same right that speaks so much about safeties and guarantees when it comes to their IUL or their annuity life, right? You know,
Sure.
It's like, oh, I'm an annuity guy. Stock market's the gamble of the AUM world. It's not worth it. You know, it's time to be more conservative. But then in this opposite world, we're willing to take the risks for an older age person using life insurance. So I'm going to stuff them in an IUL. I'm like, wow, they can't lose money. It's like, no, they definitely can.
Right.
They definitely can. It's a much riskier endeavor, especially if you're trying to use it for like some sort of cash value accumulation and distribution strategy in retirement.
Yeah.
So
Absolutely.
What age group are you looking for a whole life sale? I mean, is it just any age group or?
Yeah. I mean, we've pitched it and we've written it for folks that are in their 30s that are in the federal space. Again, you're going to come across those young folks that still don't understand risk.
Yeah.
That don't understand, hey, you're in your 30s. Just like if we come across somebody that's in their 30s and we started talking about TSP and they're asking us, hey, I'm in the G fund. No. You're in your 30s. Don't be in the G fund.
Right.
You know, we're talking about getting into more equity-based funds, you know, but you're going to come across that 30, 35, 40-year-old that is very conservative.
Yeah.
And so we're talking to them about it, but we're also talking to the 55 and 60-year-olds.
Okay. So you
coming
will
up on
to
we will.
older age folks.
Yep.
You know, the conversation with like the 30-year-old, I heard a guy named Roger Cowan talking about this, and he's like, look, you've got this great benefit offered by the government. You're 30 years old. What's your plan 5 years from now? What are you going to do?
Yeah.
Right? Well, I don't know. It's like, you don't even know what you're going to do 5 years from now. Why are you banking all your life insurance in a government plan that's not going to go with you when you leave? Right? Why are you banking on that so heavily? All of your life insurance. The potential underwriting nature of your health right now is much better than it might be 5 years from now.
Sure.
When you are then forced to go get some private policy somewhere else.
Yeah.
It's like, why wouldn't you start that today? And if you're starting that today, it better be a permanent policy, because what's the good in buying a term policy for the next 10, 15 years? You've already got this pseudo term policy with the government, basically.
Absolutely.
Right?
And
Absolutely.
get it while you're young and you're healthy, right? I mean, that's part of the pitch.
That is part of the
You know, you're talking to somebody that's 30 years old.
Yeah.
You wait another 10 years. Oh, I'm going to hold off. How many times do you hear that?
Right.
I'm going to hold off. Well, 10 years from now, your health can be completely different.
Definitely.
So, you know, that's really what we emphasize when we're talking to younger federal leads. Look, this is the time. The premium's going to be cheaper. You're healthy right now. It's time to do this.
But they think about things like, oh, it's going to be like, oh, are you on blood thinners or heart medication, or have you had a heart attack, a stroke, or something like that? And that's the things they think about that are going to hurt them in the underwriting standpoint. They don't think about some of the things like we talked about when we were looking at the rating requirements. Like, I was surprised to see Crohn's as a rated topic.
Sure.
Yep.
It's like, I know so many young friends of mine that have Crohn's that end up, you know, they would have gotten table written.
Right.
Sure.
Right?
Yep.
And it's like, that's just one doctor's visit down the road from getting diagnosed with something like that at a young age. Something manageable, but serious.
Yeah.
You know?
Absolutely.
So then I'm curious what the conversation looks like at 55. Like, what's that conversation look like?
You know, we're balancing and seeing where they have assets.
Sure.
Right. We're talking about TSP, what that money's earmarked for.
Right.
Right. we're talking about their current life insurance situation, both in the Fed space. And sometimes we're going to come across people that, mom and dad bought them a policy when they were
let's say they got an outside
5
policy.
years old. And maybe that policy has some cash value in it.
Okay.
Right. So we can talk about maybe 1035 exchange
Okay.
that cash into a new policy. Now, granted, it's on probably different mortality tables. Right.
Right.
But people are living longer, 87, 83 years old, female, male. So maybe we have an opportunity to take that cash and put it to work.
Yeah.
And doing a 1035 exchange into a new permanent policy that's gonna benefit them down the road. Because again, to your point, Alex, we all know that they're paying for that group term. They pay into it. You think about it. You get a 30-year-old federal employee. They've got 5 times option B, right?
Yeah.
They're paying into that for 20 to 30 more years, right? And then they leave the government. What do they have?
Nothing
At all, right? They have nothing to show for it. They're not getting a refund.
No.
They have life insurance, but then wait till you see what the rates are every 5 years as you go.
They're not going to hang on to that.
Not a chance.
There's no chance. I've never met somebody looking at option B payments that's like, I'm keeping that.
Yeah, unless they're extremely unhealthy.
Right.
Maybe, but it's like they know they're gonna die, and they've got some terminal illness. That's the only time I see them doing something like that.
Yep.
And so they're not even worried about what the payments are gonna look like in 10 years.
Right.
But I mean, I don't know that I've ever had that situation.
Mm-hmm.
Maybe you guys have seen that. I've not seen that. So the folks that I'm talking to, I'll run into 55-year-olds that have an outside policy that I feel in my analysis don't have enough in deferred assets.
Sure.
Right, to live on and provide for a spouse if something were to happen. And so I'm not certain that they can get rid of FEGLI and potentially this outside policy. So to that person, how do I start having that conversation with that guy about whole life at that point? I mean,
sure.
It's just, again, looking at the cash value in that outside policy, or do you guys just pivot right to, well, do you have a policy? We go through a policy review and just talking hypotheticals, like this potentially is something that we could do.
Yeah.
What's the conversation look like for somebody?
Yeah. So
like that?
we're talking about what they potentially have,
right?
And then we're looking into what we could potentially get them,
okay,
in the outside market, especially if they already have FEGLI,
Yeah.
right? We're going to say, let's go through a trial application. Let's see how you can get approved.
Okay.
Okay. So we're going to do some field underwriting ourselves, right? We're going to ask them some medical questions. We're going to look to if they have Crohn's disease or
Sure.
anything like that. Because again, to your point, a lot of people are scared. Well, I can't get life insurance in the outside market. I'm uninsurable. May or may not be the case, but let's find out.
Right.
There's no cost to apply and see how you get approved or declined or rated.
That's smart.
And let's do a trial application. No cost to you other than our time to sit here and do the application, right?
Do you run them some quotes to get an idea of what it would be at different ratings?
We do. We run an illustration. We share the illustration with them. A number of different rating categories. We'll try to really narrow it down. Like, okay, what's your height and weight? What's your build? Do you take any medications? What are they?
Yeah.
And then we'll start narrowing it down. Are they going to be preferred? Are they going to be standard? Are they going to be rated? Are they tobacco? Are they preferred tobacco?
Right.
All these things to do a really good job of being a field underwriter and then show them those illustrations.
Yeah.
And then from that point, they can make an educated decision if it makes sense. But we just, hey, let's do a trial application. You may come back better than what we rate you on this illustration.
Right.
You may come back worse.
Right.
But it's no cost to you. You still have your life insurance through FEGLI.
You make a decision at that time.
Correct. Yeah. I mean, it's a no-brainer.
And it's just such a lock, too, at that point. I feel like and we were just saying that before, right? A signed app is just, there's so much intent behind that.
There is.
True.
Yeah. To me, they're already committed that if it comes back somewhat favorable,
if it's close to the numbers,
if it's close, there's no reason that they're going to say, oh, no, that doesn't make any sense for me.
Yeah. Yeah. I mean, yeah, it's just the risk is so high of not having it. It's like, what's the risk of not having insurance?
Right. And really, if, backing up a step in our approach to these folks, in that previous episode that we talked about where we go through our LIFE needs analysis to really find out how much life insurance you need. When you do that process with somebody and they think, oh, I just need 50,000.
Mm.
And you show them that they need 350,000. And then you talk about, well, we don't know if this is affordable for you, but this is your need, just so they have that in their head that, man, I really need 350.
Right.
I know the FEGLI space isn't going to provide that because it's going to be cost prohibitive when I go to retire. Why don't I try to get a portion of that 350 in the outside market, and let's go down that application process. So now we've identified the need. They've told you those numbers. If you go back through that LIFE illustration, it's their numbers. It's not your numbers as the advisor.
Wow, yeah.
You're asking all those questions.
Right.
And we're always going to show them the illustration for 350,000 because we can always start there, right?
Right.
And if they look and see the premiums, $500 a month, then they're like, that's not attainable.
No, yeah.
We can always go down.
Sure.
You know, but you just never know what somebody's affordability level is, right?
Yeah. Yeah.
So why not show them what their need is and then step down from there?
And
It's brilliant. I mean, it really is.
to add to the illustration part. So in a whole life policy, we got guaranteed cash value, right? It shows a guaranteed column. It shows a non-guaranteed column based upon current rates and a dividend schedule.
Yeah.
So what we also do is, okay, 40-year-old, $100,000 policy. It's going to be $200 a month.
Okay.
You can pay on it 20 years. Go out to 60. They're getting ready to retire.
Okay.
Right? They're they're leaving at 60. They got their 60 and 20. They're out the door.
Mm-hmm.
We'll show them that at 60 years old, if they say, hey, you know what? They saved enough in their TSP. They really don't have a life insurance need as much. They've paid off all their debt.
Kids are grown.
Kids are growing and off the payroll. If you decide to cancel this policy, this is what the cash value, they're going to write you a check for this amount. But on the illustration, it also shows what you've paid in premium. So for instance, let's say you've paid $40,000 in premium, but your cash value is $35,000.
Like you paid $5,000.
You paid $5,000 over 20 years.
Versus you could have had a 20-year term that you would have paid way more than $5,000
Correct.
for that same period.
And I've had people argue this with me since I've been in the business 20 years. Term policies are cheaper than permanent policies.
No, not in that case.
And I'll say it is on a monthly basis when you look at it on the surface. But if we go out in the same period of time, 20 years, that example, you're getting a refund of your premium. It's costing you a net of this. In 20 years on a term policy, what are you getting refunded if in 20 years you celebrate your 50th, 51st birthday or whatever, 21 years, that policy has now become an annual renewable term most likely.
Yeah.
And you get nothing back. Just like your FEGLI, when you quit or retire, you get nothing from all those premiums you've paid for.
It's like having a car with a great resale value versus leasing a car. You know what I mean?
Yeah.
It's like you just dumping that car into that or that payment into that lease.
Right.
It's renting versus owning.
Renting versus owning, any analogy like that, right? It's an interesting, I've never even entertained that conversation, but that's really brilliant.
Yeah.
And so, okay, then talk to, well, you mentioned dividends. Cover dividends for folks that don't understand with whole life, how the dividends process works. Because a lot of whole life guys talk about dividends. You want to be with a good dividend paying company.
Yep. You want to be with a mutual company that pays dividends, right? They're never guaranteed, but most dividend paying companies have been doing it for 100 years and they haven't missed a year.
Right.
And, there's multiple options. You can take those dividends as cash. You can take them as premium reduction. You can also use them to buy additional paid up life insurance. So you buy a $50,000 policy and you might have within 20 years, you might have an additional $10,000 worth of paid up life insurance.
Great.
And so you're getting an added benefit.
Sure.
You're not paying for it. And so getting a policy that has dividend options is phenomenal in my mind.
So then talk to us about what carrier you've been working with. You've been working with this Americo product. Meritus product, sorry.
Yep.
Meritus product. And this Meritus product is good dividend paying company.
It is. They've paid dividends since their inception, missing a few years. But for the past 20 years, it's been paying dividends.
Yeah.
And, they have a whole portfolio.
Yeah.
They have whole life. They have term. They have ULs. They have IULs. They have all of them.
Which is good. We were talking about well, we were talking about Brian Benham, right, and his experience adding AUM, right, and we felt initially that he's gonna lose steam on the annuity side because he's offered this new service and it's the sexy world of AUM, right?
Right.
And in turn, because he's offering this service, he ended up writing more annuities than he had ever done. He'd increased it by 30-40%, his annuity volume of annuity sales. It's the same kind of thing when you're a type of advisor that deals with when carriers end up offering a different product out there.
Sure.
I feel like, or an advisor gets more well-versed or is offering IULs or ULs and just knows all the different options and where they best suited, they put themselves in this place where they end up selling more of whichever product they're passionate about. In your case, it's whole life, whatever. If it's IULs and they really feel, it's like the more education we can do on these products, whether it is leaning them into whole life.
Right.
I then like to pair it with having a carrier that offers everything. And the reason being is we as producers got to recognize that it's in our best interest potentially, even though we're independent, to find a carrier that does a lot of things well and to put as much production in one carrier bucket because there's a lot of incentives to hitting certain carrier bonuses and other things like that.
Sure.
Right?
Yep.
But then that bodes the question as an independent advisor, you got to find the right carrier that does those things well and puts the client first, right? And so you feel very much so that Emeritus has done that.
They have.
Yeah.
They have. Their underwriting process, their back office is very smooth. You can get a policy underwritten in 10 days or less.
10 days.
10 days.
Yeah.
Yeah.
You mentioned that earlier. I was just like, that's ridiculous, man. I've been dealing with nightmares.
Yeah. I mean, short of them requesting an APS for some unique medical condition, and then obviously you're waiting on the doctor's office to get that APS over to you. Other than that, I mean, another thing that I really like about it is they assign you a dedicated processor and a dedicated underwriter.
Really?
So you're not, they have
not
an 800.
chasing the tails.
You're not chasing it.
Yeah.
You have a direct line to both of those folks.
Is it always the same person or is it just for that policy?
It's the same person.
Really?
It's a dedicated line. It's like having the bat phone.
Really?
And you can pick up, phone, call.
That's like a source of all the headaches, too.
It's
just lack of understanding of what's holding this up or what's the issue or why did it get rated or,
sure.
And
they have, they have their internal sales desk. If you have questions about an illustration or anything like that, you need help running the illustration, they've got the resources.
What about the accelerated underwriting? I thought that was pretty interesting.
Yeah, so the accelerated underwriting is great. Every application you get the opportunity to say, do you want to try to go through accelerated underwriting?
Yeah.
And it's not simplified issue. It's not the rates of simplified issue.
Right.
It's basically a process that they use where as you're going through the application, they're running the MIB, they're running the prescription check, they're running the driving record, et cetera, and they're assessing a score based upon what they find in those things. And if it pops up in the positive part of the scoring system, it's issued in a couple days.
And you said it was run by TransUnion, so they're using like a credit agency to kind of
they're using a risk assessment basically.
Yeah,
that I think is tying into MIB, Medical Information Bureau, to run all that. Hey, are you a smoker? Have you reported to your doctor that you have, these conditions?
Do you find yourself using that a lot?
All the time.
Really?
Yeah.
What happens if it's a no-fly zone? Do you have to resubmit another app?
That's the best part. You don't. It just
goes through as regular?
Goes to full underwritten.
You don't have to do anything else?
Nothing.
Wow. So
wouldn't
you just do it always then? Unless they blatantly say hey, I have one of these things.
Yeah. Again, if you've done your job as a field underwriter and you're asking all the questions about build and, conditions and medications and all that kind of stuff, then you might say, nope, I'm not going to. Because
that's something you said twice today is field underwriter. That's an interesting term, right? So being a field underwriter, that seems like a term that you picked along somewhere. I've not heard that before, but that's good. And so what does a good field underwriter do? They just understand the underwriting guidelines to a degree?
They do. Yep. You understand the underwriting guidelines. But I guess even in the annuity world, you're kind of a field underwriter.
definitely.
You know, you're saying what's the right product for him, what's the right 10-year, 7-year, 14-year. So you
Right.
are field underwriting. You're
Sure.
gathering a bunch of information. You're doing a needs analysis, and then you're giving a recommendation.
Sure.
But yes, field underwriter on the life side, it's that find as much information as you can. And there's some people, some life agents out there, even the old dogs that have been doing it longer than myself, they don't want to do it. They don't want to ask those questions because they feel they're being intrusive on that person about, oh, you don't need to know my medical history.
And it's never fun to ask a woman what their height and weight is.
Yeah, but you got to.
But you have to, right?
Have to.
It's understood at that point. It's
Right.
like, this isn't a, this is a basic fundamental question of.
Right. And we always laugh about with them. This is the worst question we could possibly ask you, but we have to ask you this.
Right.
And they laugh, and it kind of
Keep it light.
takes the edge off.
Sure.
So yeah,
It's just, I think too many folks, particularly in the life sale guys or people dabbling in life or clinging into a sale just loosely, like they have the sale loosely, they're scared to be good field underwriters because they're scared of unwinding their deal.
Absolutely.
And it
They're
makes
afraid of
no
rejection.
logical sense whatsoever because it's just going to get denied. But it's just, and for some, that's why they default to simplified issue. Even though they could get a better potential rate or a potential product for somebody, build better cash value for somebody.
Sure.
They'll go to simplified issue because it's going to go through quicker and I don't have to risk losing this sale.
it's just taking the easy way out.
Easy way out.
You're not doing what's best for your client
No.
by going down that road.
Right.
There's no chance.
Right.
You don't think there's any chance they're doing the right thing for their client.
Not just going in and writing simplified issue right away. No.
Because
I'm glad you said it. I agree.
Yeah.
Yep.
I don't think it's right.
Right. Well, those, we've written simplified issue, and the attrition rate on simplified issue versus fully underwritten is much higher.
Like the persistency rate?
Yeah.
Like it just doesn't stay in force?
No, correct. Yeah. You'll have more simplified issue policies drop off than you will on fully underwritten. And the reason being is, and again, I'm not against simplified issue.
Yeah.
But we all know simplified issue policies are anywhere from 300 to 400% above what a fully underwritten product premium will be.
Right.
Right. So if you write a simplified issue product or policy for somebody, and then they, at the water cooler, they're talking with their colleagues and they're like, well, I got the same death benefit and it was $300 less a month or $200 less a month.
Well, Tim, I'm on blood thinners, so, it's like, that's what they'll say. And then they'll be like, well, I'm on blood thinners too.
Right.
Right.
Yeah. And then they're going to say, oh, well, who's your agent? And then there's no loyalty.
Yeah.
And they're going to be like, oh, well, your agent got you a policy for $150 a month. I'm paying $300.
That's interesting.
Let me get your agent's number. I'm going to call them. And guess what? Then your policy's dropping off. You're getting a charge back, so on and so forth. I will find more fully underwritten policies stick on the books and have a higher retention rate than I would with any simplified issue product.
Particularly in whole life, too, if you're selling the whole life.
Absolutely.
There's just
and then
more structure guarantees there.
Yeah.
I mean, once it's in place, it's very hard to replace something like that.
Yep.
But what about, okay, so then when is the right time? If you're not fully against simplified issue, when is the right time then?
somebody that has a lot of medical conditions,
For sure.
Because on the simplified,
Because they get denied somewhere else?
so, and again, it's very rare that we use the simplified platform, but there are times when it's needed.
Sure.
Somebody's completely uninsurable. Well, we might even have to go the guaranteed issue side.
Right.
Yeah.
But
If
then
they're
you're talking,
desperate and need that money.
right. But see, at that point,
I'd be looking for every other out before I went to the guarantee.
you go to the guaranteed issue side, and I'm talking to a Fed employee.
Hmm.
I'm like, well, just keep your basic, take your
keep your
75%
basic,
reduction
yeah.
at
Yeah, good
65
point.
years old,
Good point.
and get your final expense policy. That's what you need.
The basic isn't that expensive. It's just not enough money.
It's not
In most guaranteed issue products, I think the highest they go to is
25,
30,000. So
Yeah,
that's
yeah.
essentially what your
It's
basic.
option A.
That's your
It's
basic.
definitely your basic.
into
yeah.
retirement.
or
Yeah,
their graded benefit, where the first 2 years you die in the first 2 years of the policy period. It's not a full payout.
Right.
It's 10% of what you pay, 10% above the
Good
premium
point.
you paid for the
Right.
first 2 years.
That's a good point.
So in that arena, You know, are you getting the best bang for your buck for your client?
Mm-hmm.
You know, one of the other things, talking about retention and keeping a high retention rate is let's go back to a 30-year-old,
Sure.
35-year-old,
Yeah.
that we've written some life for, and they're happy. They've established a policy that they know when they retire in 20, 25 years is going to be there for them. It's going to have some value to it. Who do you think they're going to turn to roll over their TSP?
Oh, yeah.
I mean, it's a no-brainer. You know
That's
that
the
you're going to
home
get.
run.
It is.
Well, and I think that's where a lot of the agents out there are missing out, right? I mean, it's, I don't want to go through all this life insurance stuff. It's a hassle for not that much money. That's just not the case. I mean,
Yeah, I don't think that's true.
yeah.
If that's their thought, they don't know how life insurance commissions work.
Right.
Or they're not familiar with it, or
Right.
they're selling term policies.
Right.
And, they're not really selling anything. They're just, taking an easy road.
Yeah, once you have a client, you usually have them for life. So what Tim said is just so true. Like
Yeah.
20 years down the road, they're going to rely on you to help them with the TSP.
Yeah. And the more folks, and not to mention all the referrals along the way of that 20-year relationship. But, I do think that particularly folks watching this show, they recognize that they want the opportunity to harvest a client future down the road, and they're willing to. Their thought on the commissions is still exactly right? Like they just don't think they're going to get paid anything, and it's going to be a headache or whatever. But they do see like the juice will be worth the squeeze if I can roll their TSP down the road.
Sure.
But then they do one, and they do it with potentially a bad carrier, right? And that carrier drags them along and then table rates them unexpectedly because they didn't do good field underwriting, or
Sure.
they sell a simplified issue product and they Google search and find that they could have gotten a lower rate, and so the sale doesn't go through, or the person, they're chasing their tail with the medical exams. All of these things happen, and then they never go back to that well ever again. I'll put them in my CRM system, and they'll get emailed for the next year, and they'll come back to me, one day.
Yeah.
That's the flaw. The fatal flaw is that they haven't had somebody to help them understand the process, understand the value of a good carrier partner, understand the benefits of whole life over IUL, not getting egg in your face on potentially risky guarantees, seeing the inconsistencies in your pitch, right? Like you're pitching safety and guarantees all over the place with your annuities, and then you're getting real risky with your life insurance plays with folks.
Right.
Talking to young folks and not knowing, that they need something outside potentially. I mean, I think there's a lot of unknowns as to why they're selling the life insurance. And the only thing they really understand is Fagley's not going to be a good deal for them.
Right.
Right. And so for that reason alone, I need to replace this. And that's not enough.
Right. No. Exactly right.
I don't think that's enough understanding. But anyway, very interesting thought. So, Emeritus.
Yep.
Something that we're going to be doing some more stuff. Maybe, we have the luxury of having you in the office today, but we'll definitely want to do some stuff from afar, just kind of walk through the Emeritus product line, maybe show an illustration, walk through the pitch. I'm very interested to see the illustration lineup with the cash value build next to the actual cost outlays that you've gone through over, say, a 20-year period.
Sure.
That's an interesting page. That's a huge selling point to me. I mean, what a no-brainer.
When you can see that your net cost is X and it's much less than, because that's the common misconception. Whole life is so expensive. And, but when you look at the net cost, it's not.
It's not over time. That's interesting.
We can go down the product rabbit hole, but I mean, they have policies that, you pay on for 25 years or age 75, and it's a paid up policy.
Yeah.
And guess what? If you're retiring at 60 or 65 and by 75, you're not paying on anything anymore, and you have all this cash sitting there that you can access if you want.
Yeah.
Right.
And so folks will go, oh, well, IULs will do that much more efficiently over time.
Mm-hmm.
And your points before were, potentially, maybe, and hopefully you'll stay, cognizant of what's going on each and every year and
interest
sitting
rate
down.
environment,
Interest rate environment and the cost of insurance potentially going up, and then also being willing to have those conversations occasionally over the next 20 years.
They could be tough sometimes, right?
That will definitely be tough at times, I feel like.
Yeah.
You know?
Yeah.
And, oh, yeah, we need to fund more. I know I told you we'd only have to fund this amount, but we're going to need to fund more, and if we're going to keep it that plan. And you've got cautionary tales. I've got plenty of cautionary tales of looking at folks' IULs.
Sure.
And it's definitely worried me. And so between you guys coming in, we had Trent on recently, and he was talking about whole life. This whole life just seems to be taking the show. It's stealing the show from this IUL world. The IUL world was so hot for 5 years. I mean, that's all you heard about. And now we're like 5 years into the IUL world, and folks are getting worried, seeing stuff, go awry or plans not coming to fruition. And anyway, it's an interesting thought.
I mean, if advisors don't do a great job of doing annual reviews with their clients and making sure they understand the interest rate environment and how they're affected and the indices and how they're affecting the policy, and cost of insurance. I mean, no, I don't want to say that a whole life is a set it and forget it, but and it's not.
I don't know if it is,
but it's got those 3 G's that we talked about, and
there's just something. I mean, it's less flexible, right? At least death benefit wise, it is what it is. We've signed up for this. This is what's going to happen, right?
That's right. And that all goes back to their need. What's your need?
Yeah. So how good of a job did you do up front?
Right. Yeah.
All good stuff, guys. Thank you guys for coming on.
Absolutely.
And sharing some wisdoms. I appreciate that.
Yep.
So you guys, if you don't know Tim and Joe, you're going to definitely get to know them. They'll be definitely qualifying for all of Megastar's top trips and incentives and everything. If you're interested in learning more about any of the trips and stuff offered through Megastar and our carrier partners, feel free to reach out to the home office. But you'll be seeing a lot of these guys. They'll be winning some awards this year for top shops and stuff. So congratulations, guys, on a great year.
Thank you.
Appreciate you guys. We'll see everybody next time here on Coffee Close.